Hey everyone, Dean here, and welcome back to the channel where I break down the latest trends shaping real estate and smart investing. Today we're diving into the current state of the industrial real estate market in the Greater Toronto Area, or GTA, Canada's industrial powerhouse. Whether you're an investor, occupier, landlord, or just curious about commercial real estate trends, this video will give you a clear picture of what's happening now and what to expect through mid-2026. The GTA leads Canada in industrial sales activity, with an impressive $2.6 billion in sales so far this year, nearly half of all industrial transactions nationwide. But here's the catch. While that number sounds strong, it's actually down nearly 29% from last year. Why the drop? The market is feeling the effects of increasing vacancies and shrinking demand. Vacancy rates across Canada have climbed to 5.5%, and the GTA itself has seen negative net absorption of about 1.9 million square feet. Simply put, more space is available than what tenants currently need. Imagine a warehouse that's just emptied out, sitting unused for months. That's what's happening on a large scale. This has caused some slowdown in demand, along with softening rents. Plus, the size of deals is shrinking. Investors and buyers are favoring smaller, more stable assets in prime locations. For example, industrial properties near major highways in Mississauga and Brampton remain popular because they offer easy access for logistics companies, even as other areas see less demand. Now let's talk about cap rates, which are a key metric for investors. They basically tell you what kind of return you can expect from a property relative to its price. In the GTA, industrial cap rates range between about 5.25% to 6.5% depending on the property class. This is slightly higher than Vancouver, where caps range from roughly 4.5% to 5.5%. Why does this matter? Higher cap rates often indicate increased risk or market uncertainty, but they can also signal opportunity. So with the GTA cap rates edging up, investors might find attractive entry points, especially for high-quality warehouses or logistics hubs. For instance, a Class A warehouse with long-term tenant leases near Pearson Airport could offer relatively stable income despite economic jitters. Looking forward into mid-2026, the industrial market will likely face continued challenges. Vacancy rates may rise further before stabilizing, and leasing activity could remain sluggish because of cautious manufacturing and consumer demand, responding to inflation and higher costs. Yet, it's not all gloom. Prime industrial parks in Vaughan and Mississauga stand out as areas with rental growth potential once absorption picks up. Picture an e-commerce giant expanding its distribution center in one of these industrial parks. This kind of tenant demand can quickly reverse vacancy trends and push rents up. Investors should focus on assets with inflation-hedged, long-term leases in well-connected locations to reduce risk. Occupiers benefit from targeting sites near major transportation routes to support efficient supply chains. Landlords might consider flexible rental terms or incentives to attract and retain tenants in this softening market. Let's bring this to life with an example. Suppose you're a logistics company looking to lease space in the GTA. You might find smaller facilities near highway interchanges in Brampton that are competitively priced due to overall market softness. Locking in a long-term lease there now could mean cost savings and operational stability, positioning your company well when demand normalizes. Or, from an investor's perspective, buying a modern high-bay warehouse leased to an e-commerce company near Pearson Airport could generate steady income even if overall market activity slows. Long-term leases and tenant quality are your security blankets. Key takeaways: the GTA remains Canada's industrial hub, despite a slowdown. Vacancy rates and negative absorption signal short-term challenges. Cap rates have risen, offering entry points for astute investors. Focus on prime, well-connected assets with quality tenants. Market stabilization is expected mid-2026, presenting opportunities for prepared stakeholders. Thanks for watching. If you found this useful, give us a thumbs up and subscribe for more real estate insights and updates. Have questions or want a personalized consultation on GTA industrial properties? Drop a comment or reach out directly. Links are on the description. Let us help you discover the perfect location for your next big opportunity. Until next time, stay informed and invested smartly.